What's up, everyone? My name is Finance CJ. Thanks for joining me for another fantastic Finance Friday. I hope you all had a wonderful week, and thank you for joining me for episode 5 of my personal finance and investing channel. Now, today we're going to talk about the real estate market. If you didn't check out my last video, there will be a link down below and at the end of the video about investing in the stock market. I talked about this because this is the two ways that wealthy people generally make money and grow their wealth. The 4 ways you can get started in real estate that I'm going to talk about today are buying and flipping a property, buying a rental property to rent out, investing in crowdsourcing, and investing in REITs, otherwise known as real estate investment trusts. Now, these are done through the stock market, and that's why these two coincide. Now, you may be thinking, what does a 23-year-old know about real estate investing? And to that, I say you are exactly right. I am not a licensed professional. I have no exposure into actual real estate. This is just what I've learned in my year of investing, and this is the knowledge I want to share with you today. First, we should talk about why you should be getting involved in the real estate market as opposed to the stock market. Now, personally, I would say you should be invested in both, because being invested in both keeps you diversified and protected in case of a crash in one or the other. Talking about returns, the stock market has returned 7 to 10% year over year, while the real estate market has lagged. It has been 4 to 6%, but there are other reasons to get involved in the real estate market. The real estate market allows you to leverage your money if you own the property, and it also gives you certain tax advantages from owning the property. All these details we will go into at a later date, but this is just the basics that we're going to talk about today. Now, to talk about if you have a lot of capital on hand or only a tiny bit of cash on the side. These will limit what you can do with your options, and the first option we're going to talk about is buying a property to flip it. Now, this to me is the most expensive and the most difficult option, because you not only have to find a house to flip, you have to find an undervalued house in a good neighborhood that is going to have a better resale value than when you bought it. This also means you have to find a house that has no issues, no problems, or minor things that can be fixed relatively quickly so that you can turn a profit. According to HomeLight blog, we know that flippers generally had an average ROI, or return on investment, of 40.6%. Now, that may sound good to all of you watching at home, but I'd just like to remind you all the struggles that went into achieving that return on investment. They had to find the property and they had to fix it up. They also had to hope that there's no issues where they need city permits, and they also needed to hope that the house sold relatively quickly on the market. Flipping a house may look fun from what you see on TV, but I assure you it is no easy feat. Next option is more realistic and probably easier to achieve. You still have to find an undervalued home, and you still have to be able to put some money into it. If you do your own due diligence and you find a reliable tenant, you can create a steady and stable source of income. Now, before you find the tenant, you have found the location, you found the house, and you fixed it up. You can even pull equity out of the house if you go through a refinance and the house appraises for more than it is. These are all more in-depth details, but what I want you to know is we will talk about these things at a later date. The next thing to do is set the rent. The best part about this is the average rent has been increasing every month for the last 2 years. The average rent now is at $1,463, while the average monthly mortgage is at $1,029. Now, you may be thinking, why isn't everyone doing this? It takes a lot of capital to buy a house. Also, this is not including home insurance, private mortgage insurance, or taxes. All these get filtered in and fall on the landlord or the homeowner. Also, this does not cover any repairs or expenses that come with owning the house. But on average, you are making a little money already. On top of all these things, the property value is generally rising, especially if you did your research and you picked a good neighborhood where home values are increasing. You can buy a house 1 year and it can be worth 10% more the next year, if you're lucky. Now, renting out a property is no easy feat, and it can be challenging to find the right person to rent a property to. But if you do all these things right, you can create a steady income, and you will be getting a stable line of cash to pay off the mortgage and eventually have a completely paid off home, which then you can sell for a total lump sum profit. Or you can continue to rent it to the tenant, and you can continue to have that stable income, and it goes straight into your pocket. If you're like me, though, and you have $20,000 of debt, you're not going to be doing this anytime soon, especially if you don't have any money saved. Now I'm going to talk about two options that you can do on your own. The first is crowdsourcing with an app called Fundrise. This allows you to actually invest in properties that are being developed and managed with as little as $500. This app is similar to the stock market, where you can invest with a small amount of capital, but like I said, the minimum is $500. I, for one, do not invest in Fundrise. I have not gotten around to it, as I am trying to aggressively pay off my debt, but I do recommend some YouTubers such as Andre Jick and Ryan Scribner. These are YouTubers who have Fundrise accounts and actively show their accounts, so they are much better to see the returns, but I can take you through some of the numbers I got off Fundrise's website. Now, according to Fundrise, they are producing returns of 10% per year, which is very good for a real estate market. As we talked about, the average has been 4 to 6%. You can choose different ways to manage your portfolio depending on if you're looking for growth or if you're looking for dividend investing. Both options come with their benefits. Dividend gives you more passive income, while growth is a little more risky, but you can also choose a mix of both, which is generally what people do. The only problem that I see with Fundrise is the money is not liquid, and if you're like me, you could need your money at any instance. The reason your money is not liquid is because it is actively being invested in real properties that you can see on the app. So if you're looking for a way to make quick money and pull your money out at the drop of a hat, this is not for you, but I do have one last recommendation for you. We're going to talk about REITs. As I said, they're real estate investment trusts, REITs. A REIT is basically a stock that you can buy and sell, and you are investing in the parent company that oversees the properties. Now I'm going to talk to you about a good basket I would like to hold, as well as how REITs operate. Now the perks of REITs are you're still getting exposure into the real estate market, but you have less of a risk on your shoulders. You can invest in places that run ski resorts, you can invest in movie theaters, you can invest in office spaces, doctor's offices, music offices, anything like that. To start talking about REITs, we need to know what classifies a REIT as a REIT. Now the main thing is that 90% of their FFO has to come back to their shareholders. FFO means funds from operation, FFO. This means what they're generating from their properties, 90% of that has to come back to shareholders in the form of a dividend. Now, the problem with this is it's a special taxable dividend for shareholders, but it's what lets a company maintain their REIT status. Like I said, REITs are good because they are considered a liquid investment. You can trade in and out of them at your leisure, and that's why I like to invest in them. Since we have the basics down, let's move on to building a basket of REITs that is a safe and secure option for investors. Now let's start talking about the basket of REITs. First I'll mention the sectors, and then I'll go through the actual names and tickers of the companies. Retail shopping, data centers or digital REITs, e-commerce warehouse, storage centers, and medical real estate. Now, the first thing we'll talk about is retail shopping. As we've all seen, the pandemic has taken a toll on all of us, and I believe there is some consumer pent-up demand. The first company is Simon Property Group. They own a bunch of Class A malls across the country. They are the most well-known and recognizable mall with the best cash flow on the books. The ticker for Simon Property Group is SPG. The second retail opportunity is Tanger Outlets. As we know, people are trying to be more outdoors, and this is the best outdoor shopping centers there are, ticker SKT. As we know from working from home or doing school online, data is becoming more and more used. So how do we store this? We use digital REITs. A couple companies are Digital Realty Trust, or ticker DLR, and Equinix, EQIX. Both of these have warehouses where they store massive servers, and they charge people to store their servers and their data there. The next ones are e-commerce and public storage warehouses. Now, if you're like me, you probably did a lot of shopping for Amazon during the pandemic and even with Christmas coming up. Also, people still need to store their stuff and people still pay a premium to store their stuff. So the two companies we have are Prologis, PLD, and PSA Storage, ticker PSA. Prologis owns the warehouses that Amazon use as fulfillment centers. PSA Storage is a very well-known storage area. Next thing we're going to talk about is medical and elderly care facilities. Everyone knows that you need a doctor, and everyone knows that you get older. The two companies we're going to talk about is Physicians Realty Trust, ticker DOC, and LTC Properties, tickers LTC. Now, the reason we are talking about these is Physicians Realty Trust is the largest medical office REIT on the market. For elderly care facilities, we're going to talk about LTC Properties. With life expectancy always growing, these facilities keep growing as well. They need more and more space for the more people who are going into these long care facilities. This means they have a large growth potential for investors. I hope you guys learned something about real estate investments, and if you did, please leave a like down below. Don't forget to comment and subscribe. Don't forget to hit the notification bell so you know when my videos are posted. I post weekly. Thanks to my producer, TJ DeRosa, for all his work behind the screen, making me look good. See you next week, guys.